One of the things that's often discussed with permanent life insurance is the ability to borrow the cash surrender value from that policy. And in this video, I'm going to explain the 3 different ways that you can access the value within your permanent life insurance policy. And by the end of this video, not only will you know all 3 different ways you can access it, but also some very important planning considerations that you need to be aware of that could be the potential downfall of this strategy. What's up, guys? For those of you who do not know me, my name is Philip Setter. I'm the founder and CEO of Affinity Life, where we've helped hundreds of Canadians find the right life insurance coverage at the right price, all from the comfort of their own home. So if that sounds interesting to you, I'll put the link in the description below and you can check it out. But without further ado, let's get right into the video. Okay, so before we talk about borrowing from a life insurance policy, let's just kind of go over the basics of life insurance so you kind of get a good idea what's going on here. So we have 2 different types of life insurance here in Canada. We have term life insurance and we have permanent life insurance. So term life insurance, very easy to understand. We have term 10, term 20, term 30, very inexpensive option. It covers you for that specific period of time. And at the end, you usually have 3 options. Number 1, you can cancel it and maybe find another policy on the market, or maybe you don't need it anymore at that point. Number 2, you can usually renew your policy. So if the company that you got life insurance from has renewability, you can renew it for another term regardless of your health condition at that point. And number 3, if again, it's a convertible life insurance policy, you can convert it into a permanent life insurance policy regardless of your medical condition at that time. Now, permanent life insurance, there's 2 different types here. We have whole life and we have universal life, and they both have this like investment or cash value within it. With whole life, it's something known as cash surrender value. With universal life, it's known as the investment account. Now, you will hear a lot of advisors talking about using life insurance as an investment and using it maybe to fund your retirement and supplement your income. And maybe you need life insurance when you pass away, so it might be a good idea to purchase it. Now, here's my opinion on this. For the vast majority of Canadians, this is not a great idea. If you compare this to just a traditional RRSP or TFSA, you'll start to see it falls apart a little bit. And I made another video where I detailed apples to apples this comparison, RRSP versus a invest in life insurance strategy. And if you're interested in that, just drop a comment below asking for it. However, for the minority of Canadians who are those high income earners that have already maybe maxed out other traditional vehicles, they're in a high tax rate and they're looking for other tax strategies, this could be a very good strategy. And maybe you want to borrow from your life insurance policy. So let's actually get into the borrowing of life insurance. So like I mentioned, we have 2 different types of permanent life insurance here in Canada, whole life and universal life. Whole life is very easy to get a loan against. In most cases, you can lend up to 90% of the cash surrender value within that policy. So if the value is $100,000, you can usually borrow up to $90,000. It's relatively easy, and I'm going to explain how you do it here later on. With universal life, it gets a little bit more complicated because with universal life, you can pick and choose different funds to be invested in. With whole life, the insurance company, it's a fixed rate. They're doing their thing, they're getting returns, and they're returning them to you, and that's growing your cash surrender value. So they're in control of that. They know what their return is going to be. It's relatively stable. They've been doing it for 100 years. They know what's going on. With universal life, you're the one, hopefully with your advisor, that's picking the funds. And so this is where the percentage starts to get a little bit more difficult to nail down. And usually if you do want to try and get a loan up to 90% of the value of your investment fund, they will want to see you in a pretty stable fixed income type of investment. They do not want to see you in any type of high risk equity position or something like that. So you will need to keep this in mind. If you do have a universal life, it's going to be a little bit different. I'm going to focus on whole life within this video just because it's a little bit easier to understand. So the easiest way to explain whole life insurance and the cash surrender value within a whole life insurance policy is I most easily equate it to a house. You buy a house, and what do you have within that house? You have equity within that house. And just like you couldn't go down to, your Safeway or your grocery store or a car dealership and buy a car with the equity in your house, you need to get something against it. You need to get a loan or something else against it. And so it works very similarly with the cash surrender value within a whole life insurance policy. So just like with the equity in your home, you could sell your home and you would get paid that amount. It works the same with whole life. So let's get into the first way that you can access the cash surrender value within your whole life policy. And that is you can either fully surrender your policy or you can partially surrender your policy. Well, what does that mean? Well, a full surrender of your policy essentially means that you would go and you would surrender it. You would say, hey, I don't want this policy anymore. Let's cancel it. Pay me whatever it is, and I'm going to go on my way. So what would that look like? Well, there would be some taxes that are applicable. And what that is anything in excess of what's known as the adjusted cost basis within that policy would be taxable. So here's an example. Let's say that you had a whole life insurance policy that was $1 million of face amount. So that's your death benefit. And let's say the cash surrender value is $200,000 and the adjusted cost basis within that policy was $50,000. Well, if you did a full surrender of that policy, then you would receive that $200,000 and that would go to you, okay? You would no longer have the life insurance, so the death benefit would go away. That would be gone. And because you have that $50,000 ACB, anything in excess of that would be taxable. So you would still receive $200,000. However, in that year, you would get $150,000 added as taxable income to your return. And so you'd have to pay taxes on that, which may or may not be a good idea or a good solution at the time. In most cases, it's not. You don't want to have to pay taxes on that income. Now, the other thing that you can do is instead of doing a full surrender, you can do a partial surrender. So that's very similar to what it sounds like, all right? Instead of giving up $1 million of the death benefit, you just give up a portion of it. Maybe it's $250,000. So you give a quarter of your benefit up, and that's going to reduce your face amount and your cash surrender value accordingly. So you give up a quarter, your face amount goes down to $750, your cash surrender value goes down to $150, and now you would essentially get paid that $50,000. Now, the way the taxes work with this is it's on a prorated basis. So it's not going to be 100% tax-free. They're basically going to divide 200,000 by the 50 to get that prorated amount, and it's going to be a quarter. So a quarter of that $50,000 cash surrender value that you would receive as a cash, cash check in the mail would be a quarter of 50,000, what, 12,050? So 12,500 would be taxable. So that's how a partial surrender works. Now, the second way that you can access the cash surrender value within your whole life insurance policy is something known as a policy loan. Now, a policy loan is a loan directly from the insurance company that issued your insurance. So they're the ones that are giving you that loan. So if you bought a whole life insurance policy with Equitable and you got a policy loan, Equitable would be giving you that loan. Now, depending on what the interest rate environment of Canada is at the time, interest rates can range anywhere from 4 to 7%, depending on, again, what the interest rates are in Canada. But usually it's in that 4 to 7% range. So you'd be paying that interest. You're probably thinking, well, this kind of sucks. I'm paying interest to use my own money. However, don't forget that that's not going to affect any value within your life insurance contract. So your cash surrender value is still going to be growing, and it's not going to affect, it's not like you're taking that cash surrender value out like it is with a policy loan. It's still going to be growing. And so one of the things that you can do with a policy loan and a collateral loan, which I'm going to talk about after this, is you can capitalize the loan. So what does that mean? Well, capitalize the loan means essentially you're not actually paying the interest, you're just tacking it on to the overall outstanding debt. And then upon death, your life insurance proceeds will pay off that loan. And so what you're kind of banking on is that your loan, the interest rate on your loan, pardon me, is going to be smaller than what you're earning within your cash surrender value. So this is a very common strategy for a lot of people that are taking a loan out of their life insurance policy and they don't want to pay the interest on it. So they just capitalize it, add it onto the outstanding bill. Their face amount is going to be reduced, but they are going to be able to use this income during their retirement or whenever they want to use it. So this could be a very good option. Now, one of the biggest pros of a policy loan is that your credit worthiness doesn't really matter because essentially it's from the insurance company that holds your life insurance contract. They're not really going to be looking at your credit worthiness. They're not going to be looking at your debt service ratio. You don't need to qualify as much for this loan or really at all. I mean, it's contractually obligated that they're going to give it to you. So that's the biggest pro of policy loan, is that it's pretty well guaranteed to get this loan. Now, the biggest con of policy loans here in Canada is the taxation. Now, taxation works very differently than in the United States. In the United States, policy loans are not taxable. So if you see a lot of different people in YouTube and TikTok and wherever else talking about how you can take all these policy loans tax-free, they might be talking about the United States. In Canada, it's totally different. So in Canada, the way that policy loans work from a taxation point of view is anything in excess of that ACB is going to be taxable. And you're probably thinking, Philip, what the hell is ACB within a life insurance policy? I don't get it. When I hear ACB, I think about investments, and you want a high ACB because that means very little capital gain. It works kind of the same within a life insurance policy. See, here's the thing. A policy loan is actually considered a disposition. So it's kind of like that capital gain, except it's not treated as a capital gain. So this is how it works. When you initially purchase your whole life insurance policy, the ACB within that policy is going to continue to rise over time. So the way that ACB works within a whole life insurance policy is that as you pay premiums, that's going to drive your adjusted cost basis up. And then as you get older and your mortality rate increases, that's going to bring it down. So what does that mean? That means that the early years within your policy, you can probably take a policy loan without any taxable consequence. But the later years, as you start to get into retirement and a little bit older, your ACB is going to start to drop and your policy loans could become taxable at that point. That's the biggest con of policy loans. So if you're taking a loan from your policy in the early years, a policy loan, pardon me, then it probably won't be taxable. If you're taking it in the later years, then it may become taxable. And it really depends on all the variables within your specific life insurance contract. Which brings me to the third way that you can borrow from a life insurance policy, and that's a collateral loan. Now, a collateral loan works a little bit differently than a policy loan. A policy loan is with the insurance company. A collateral loan is now with a third-party lending institution. So maybe you had a policy with Equitable Life, and then you went to another lending institution like a bank, maybe BMO, RBC, Scotiabank, one of those other banks, and you said, hey, I have this asset. Can I pledge it to you and you can use it as collateral and you give me a loan in return. And they'll look at it and they'll say, yeah, okay, sure. How much cash surrender value? Okay, there's, 150, 250,000. Sure, we'll give you a loan. And again, it's going to be in that same interest rate, 4 to 7, 4 to 6, depending on what prime rate is here in Canada. And they're going to give you this loan. And so you're probably thinking, okay, this sounds like a pretty good idea. Now, the biggest pro of a collateral loan is that it's never taxable. At least as of 2023, it's not taxable in Canada. It's not considered a disposition within your policy. There's no taxes that are ever payable, regardless of your ACB. If your ACB is high or low, it doesn't matter. And by the way, this is all for an individual. If it's a corporation, it's completely different. And if you're interested in how life insurance and borrowing from life insurance works in a corporation, drop a comment below asking for that video and I'll be happy to make it. But this is just for an individual. Now, you're probably thinking, well, that sounds great. Why doesn't everyone just do a collateral loan? That sounds way easier. It's not taxable and it's still around the same interest rate. Well, there is one big con to getting a collateral loan from a third-party lending institution, and that's the credit worthiness and the difficulty in getting the loan. So a policy loan, like I mentioned, relatively easy to get. The insurance company will give it to you regardless of your credit worthiness or regardless of your debt service ratio and regardless of the amount of the loan. That's a big one. With a policy loan, if you wanted $3,000, they'll give you $3,000. If you want $300, maybe not $300, they have maybe a $500 minimum, but it's very, very low, okay? With a collateral loan, here's what you need to know. Number one, you need credit worthiness. You need to have good credit. So if you have very poor credit and you're not in good credit standing, you might not get this type of loan. Number two, you need to make sure that your debt service ratio is still going to be able to service this debt. So if you're trying to get an amount that they see that you can't service, you might not qualify for this loan. And number three, which is the biggest one here, is they usually do not like to lend on really small amounts. And so you're probably thinking, well, Philip, what is a small amount? Well, according to most lending institutions that will lend on this type of strategy, anything under $250,000 is relatively small for them. And there are some lenders that will do it. However, the rates are just a little bit less preferential. It's a little bit more complicated to get. You might not be able to get up to 90% of the cash surrender value. And so if you're banking on this type of loan and you have a very small amount of cash surrender value within your policy, it's probably not the best idea. However, when you start to increase your value past 250 to maybe 500, even $1 million and past, that's where all of a sudden all these other lend institutions start to open up. You have a lot more people to work with. The rates are a lot more preferential and they're going to lend up to the maximum amount of 90%. So if you are looking at a collateral loan, having sufficient credit worthiness and a good DSR and also having sufficient cash surrender value within your policy is very important. Now, like I mentioned, with both policy loans and collateral loans, you can capitalize this. So you can essentially tack on the interest. You don't have to pay it every month. You can tack it onto your overall loan and you can get that paid off upon death. The face amount will pay off this loan and the remaining amount will go to your beneficiaries. So that is something to consider. However, one very important thing that you need to be aware of is if you get to a point where your loan starts to exceed 90% and your cash surrender value is not growing at the point that's able to service this loan, you could run into a situation where you need to put up additional collateral or pay off that loan, or the insurance company could cancel your contract and essentially liquidate it and pay off the loan. So when you start to look at these different types of strategies, make sure that you know what you're getting into and you have sufficient cash to service it if you need to. With all that being said, I hope that answered some of your questions about how to borrow from a life insurance policy. If you guys have any more questions, just drop them in the comments below. And if you guys are enjoying this content, all I ask is that you give it a thumbs up, and I'll see you guys in the next one.